Welcome to the Riskwiser Zone, the podcast where we dive into the world of finance and explore the latest trends, insights, and expert opinions. I'm your host, Louie, and I'm excited to have you join us today. We're starting off with a fascinating story from the world of corporate bonds in India. Despite efforts to digitize and increase access, retail investors are still cautious about entering this market. According to Jessica Shah, an expert in the field, the complexity of risk-return dynamics and transparency issues surrounding defaults or delays are major deterrents for individual investors. However, there is a silver lining. With expected rate cuts on the horizon, corporate bond issuance is likely to rise sharply in the coming quarters. The repo rate has already dropped from 6.5% in February to 5.5% by June 25, with a further 25 bps cut expected in FY 26. This could lead to a surge in short-term corporate bond issuances, driven by falling interest rates, surplus liquidity, and strong investor demand. It's also worth noting that ESG bonds are gaining popularity in India, with issuance hitting USD 55.9 billion by December 24. Renewable energy, banking, and urban infrastructure are leading the charge, while other sectors like real estate, water, and waste management are emerging as notable areas for sustainable bond-funded projects. As we explore this story further, it's essential to consider the potential risks and challenges associated with India's corporate bond market. While institutional investors continue to dominate, retail investors are slowly starting to take notice. But will they be able to overcome their concerns and participate in this growing market? We'll be keeping a close eye on these developments and bringing you expert analysis and insights to help you navigate the complex world of finance. So stay tuned for more from the Riskwiser Zone. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're exploring the world of risk management and financial planning, and we've got a fascinating story to share with you today. Our middle segment is all about navigating the complexities of estate planning and tax obligations. We're looking at a scenario where a listener, Martin, has inherited properties from his mother's estate, which are being held in a graduated rate estate, or GA. Now, this is an interesting situation because a GRA can provide some tax benefits, but it also comes with its own set of rules and regulations. The question on Martin's mind is what happens to the capital losses realized on the sale of one of the properties, specifically the hobby farm. Can these losses be used to offset capital gains from other property sales within the estate? And if so, how does that impact the tax obligations of the beneficiaries? To break it down, when someone passes away, their assets are typically transferred to their estate before being distributed to the beneficiaries. If the estate generates significant income or holds assets for an extended period, it may be required to file a T3 trust tax return. A GRI can take advantage of lower tax rates on lower income amounts, which can be beneficial for high-income beneficiaries. However, in this case, Martin wants to know if the capital losses from the hobby farm sale can be applied to reduce capital gains from other property sales within the estate. The answer lies in the tax rules surrounding GRIs and capital losses. Essentially, the estate can use these losses to offset capital gains realized or potentially claim them on the deceased person's final tax return. It's essential for Martin and the beneficiaries to understand that capital losses cannot be transferred directly to their personal tax returns. Instead, they can only be claimed against capital gains within the GRI. This means that the estate may need to strategically plan the sale of other properties to maximize the use of these capital losses and minimize tax liabilities. Now, we know this is a complex topic, and it's crucial to seek professional advice from a tax expert or financial planner to ensure compliance with all relevant laws and regulations. The Canada Revenue Agency may also scrutinize estates that seem to be delaying settlement to take advantage of GRA tax rates, so it's vital to balance tax planning opportunities with the executor's legal obligation. In conclusion, navigating the world of estate planning and tax obligations requires careful consideration and expert guidance. As we've seen in Martin's case, understanding the rules surrounding degrees and capital losses can help minimize tax liabilities and ensure a smooth settlement process. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We've got a great closing segment for you today, folks. Let's dive into some exciting news from the world of finance. We've been following the stories of two companies, Miata Metals and Devonian Health Group, as they navigate the complex landscape of private placements and fundraising. Miata Metals has announced a $3 million private placement of units, while Devonian Health Group has closed its non-brokered private placement for aggregate gross proceeds of $2,272,999.85. Now, let's take a closer look at what this means for investors. Private placements can be a great way for companies to raise capital, but they also come with their own set of risks and uncertainties. It's essential for investors to do their due diligence and carefully consider the terms and conditions of these offerings. In the case of Miata Metals, the company is looking to raise $3 million through the private placement of units, which will consist of one share and one warrant. The proceeds from this offering will likely be used to fund the company's ongoing operations and growth initiatives. Devonian Health Group, on the other hand, has closed its private placement, issuing 15,153,332 units at a price of $0.15 per unit. Each unit consists of one subordinate voting share and one share purchase warrant. The proceeds from this offering will be used to finance working capital related to the company's corporate overhead and research and development activities. As investors, it's crucial to approach these types of offerings with caution and carefully evaluate the potential risks and rewards. Private placements can offer attractive returns, but they also come with a higher level of risk compared to more traditional investment vehicles. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.